This is John Feneck, CEO of FeneckConsulting.com, as well as CEO of MiningTechnica.com. With me today again is Martin Turenne, the CEO of FPX Nickel. Website is fpxnickel.com. Martin was my guest back in July and shared a lot of insights about the company then and talked about the PEA that was coming in September of this year. Obviously this week, Martin, the news is out, and when you look at the PEA this week versus the 2013 PEA, can you tell us a little bit about the improvements that you see there?
Yeah, thanks, John. Thanks for having us on again. Yeah, it's a dramatic improvement. The previous study that was done, the preliminary economic assessment that was done in 2013, suggested this is a nickel project that requires quite a high nickel price to be feasible. So effectively kind of an out-of-the-money call option on the nickel price, if you will. What the current study shows is that at a nickel price of $7.75 a pound, so very much in line with consensus forecast for the nickel business, that this will be a project that delivers an after-tax net present value of over 1.7 billion US.
Wow.
That's based on a 35-year mine life, annual production of almost 100 million pounds of nickel per year, which would make this one of the largest nickel mines in the world, as well as operating costs, well below $3 US a pound, so in the bottom quartile of the cost curve. So all of that combined, really, it just wraps a lot of the improvements and the optimizations that we've achieved with the project in drilling and metallurgical work over the last several years. And this is kind of the first chance the market has to see what the ultimate impacts of all those optimizations have been for the economics.
Fantastic. So, a $1.7 billion NPV, that sounds quite high. I mean, is that a double, a triple over the 2013 study?
Yeah, it's about 3 times higher. The mine life has gone up as well. The mine life has gone to about 35. It's gone to 35 years now, and importantly, the payback, the period of time before you get the payback of the initial capital has also diminished significantly. It now stands at 4 years on an after-tax basis. So what that means is you've got a very long mine life project that pays back capital very quickly and leaves the ultimate operator with exposure to many upcycles in the nickel price after that initial capital has been paid back.
So how do the economics of this project compare to other nickel projects globally? Can you talk about that, please?
Yeah, sure. So of course I think as you're aware, the nickel market is one that really requires new supply to be coming online in the next several years. And so looking at various nickel projects and seeing how robust or economic they are could suggest which are those that have the advance in terms of potentially being taken out by major companies or going into production ultimately. One of the metrics we look at for assessing that, particularly for large scale projects, is to examine the ratio of the mine life to the payback period. That's where you take the overall mine life the project has and you divide it by the amount of time it's going to take to pay back that initial capital. Okay. Ideally, you want that ratio to be as high as possible. You'd want the longest possible mine life and you'd want to pay back capital as quickly as possible. So the higher that ratio, the more it suggests you have a robust project. The slide that we're looking at right now kind of shows that our Baptiste project ranks very highly on that, based on that 35-year mine life, 4-year payback. You can see we have the highest ratio in the comp group here of other nickel projects globally. And so that I think puts us in a good position with respect to those other companies.
And while we're looking at this slide, how did you determine those other, 10 or so peers? How do you define a peer?
Yeah, really, they're companies that have other nickel companies, Canadian listed or Aussie listed typically, some UK listed here as well, who have projects anywhere between the PEA or the feasibility stage. And this table just basically pulls their information from the economic studies that they have published.
Great. So, at 1.7 billion, as far as the CapEx is concerned, it's a large number. So can you talk to, what other nickel projects globally would cost, from, in terms of a comparison, please?
Yeah, it's a good question. I mean, this is a large project. It's going to have a long mine life, and it's going to have a high rate of annual production, but with that comes significant capital, absolutely. So this is one way to look at that. It's a measure of capital intensity. The blue bars on this graph show the large-scale nickel projects that were built in the last cycle of nickel mine development in the 2010 to 2013 timeframe. And what that shows is that these projects had multi-billion-dollar upfront capital, and on a per ton of annual nickel production, their upfront capital was anywhere between $53,000 to $92,000 for every ton of capacity of nickel production. And while the project capital for our Baptiste project is indeed high, in the context of large-scale nickel projects globally and of mines that were built in the last 10 years, it's actually fairly low upfront capital. So that shows what this slide is basically showing is that the nickel business is highly capital intensive, and in that context, the upfront capital for our Baptiste project is actually, relatively modest, particularly given the scale of annual production.
Yeah, it's an excellent slide. So when you look at the grade of the project, it's on the lower grade side. How does the your operating costs look versus versus peers? Because I think they look pretty low. And can you talk to why that is?
Yeah, sure. So this shows kind of the current cost curve in the nickel business based on data from Wood Mackenzie and RBC. And you can see that at $2.74 a pound, our C1 operating costs would be really within the bottom fifth of that cost curve, so very low on the cost curve for the nickel business. And to your point, it is a relatively moderate grade deposit. So how do we achieve that? There's four elements that go into how C1 or operating costs get built. I'll kind of go through them in order. So first would be your mining costs. So your mining costs in an open pit, which is what we have here, are very low. Our mining costs are around $2.50 US per ton. Whereas in an underground mining scenario, it can easily be an order of magnitude higher than that. So the mining costs here, first of all, are very low given that it's an open pit. Second would be your processing costs. Again, the process here is very simple. Processing costs are estimated to be just below $3 US a ton. Whereas in other nickel deposits, it can easily be a multiple of that. So low processing costs due to the simplicity and the very clean nature of our ore. Despite its low grade, it is very clean and lends itself to an easy method of processing. The first would be your general administrative costs. This will be a very large scale deposit. And so there's economies of scale to be gained by having a large scale of mining and milling. You're spreading an administrative cost over a much larger denominator. So your G&A costs for an operation of the scale would tend to be quite a bit lower than they would be for, let's say, a smaller scale operation. And finally, there's how much you're going to get paid for your nickel product, which is ultimately viewed as sort of a penalty or an addition to your cost. For every percent lower than the spot price you take for the nickel product you produce, that effectively is an add-on to your operating costs. In our case, we're getting paid almost 100% of the LME nickel price for our nickel units because we're producing a very high-grade product that is being sold directly to end consumers and not one that has to be sold to smelters. And so there's no smelter discounts or payables or penalties that apply to our cost structure, which again further lends the ability to produce at a very low cost. So one of the comparisons we would make here is that in the copper market, some of the lowest cost mines in the world are the big porphyry copper deposits, which tend to have moderate grades, but due to the economies of scale can still be very low on the cost curve.
That's a good analogy. So that was something I was going to ask about because we talked about the January news that you had. I think it was around January 7th, where you talked about the type of nickel and the type of end user for your product. So can you talk to what kind of nickel or what type of nickel will be produced at the Baptiste project and who will be the ultimate buyers, being that smelters are going to be out of the loop?
Yeah, good point. So so the concentrate we produce initially would be about a 63% nickel concentrate with iron and cobalt in it. The PEA is modeled on the concept that we would briquette or or agglomerate this product into briquettes and then sell that product directly to stainless steel producers, again, bypassing smelters and achieving very sort of handsome payables for the product. The other path that the product could ultimately go down is into the EV market. As you alluded to, we did some laboratory testing with Sherritt Technologies earlier this year that showed that this product is amenable to sale to the EV battery market. So over a 35-year mine life here, we've got a lot of flexibility to sell nickel in a form that's ideal for either the stainless market or for the battery market, all without having to include smelters or ultimately allowing us to bypass smelters and achieve premium revenue for our product, no matter which path it goes down.
Fantastic. And what are some of the opportunities that you see going forward for, reducing costs or improvements in the project? How does that look to you?
Yeah, I'd say there's three main things. One would be exploration. Baptiste is just one deposit at our project. The project covers a land package of 245 square kilometers. And there are a few other targets, most notably the Van target, which we think have the potential to have a deposit of a similar scale delineated. So drilling at those targets going forward to see if we can have multi-generational deposits within the same land package is going to be something that we're going to be focused on. Further work on the EV battery side to better understand the types of products that we could produce and the types of companies we could collaborate with as off-takers or end users for the nickel product going into the EV market is also important. And the third piece is we also are producing here as a byproduct a lot of iron ore concentrate. We have not included any byproduct revenues or economic value from that product in this economic study. However, we think it represents a lot of optionality, particularly in the period of high iron ore prices like we're in right now. This is a byproduct stream that could yield a lot to the bottom line of the project and just be sort of the cherry on top of the economics. So we're going to continue to do work to evaluate the opportunity to model the production of sale of that byproduct into the market and really even further reduce our costs of nickel production on a byproduct basis going forward.
Okay, great. And then two more questions. One softball and another one that is a more direct question that I think you have always been very honest and upfront with me in answering all questions, which I love. So the first question is, what are the next steps for your company going forward?
Yeah, next steps are really to start turning our focus to some of those areas of optimization that I just mentioned. And ultimately that would work towards development of a pre-feasibility study. We would hope over the next 18 to 24 months, that would be the next major milestone. But in addition, throughout all of that, you'd have a lot, I think, of potential for news flow on exploration, on the EV battery market, and on the iron ore piece. One of the other areas of focus is our work on carbon sequestration to show that this project has the potential to be a carbon neutral mine. So people can expect to hear more from us on that in the coming months as well.
Okay. And then finally, as a former analyst myself, I've been saying, publicly since March that I think a lot of analysts, whether it's, precious metals analysts or industrial metals analysts, like in your sector, are, I've used the word asleep at the wheel. I think they've woken up to some extent. But when you look at your company, Martin, since we last met, I think you got an analyst to write you up and then has since upgraded the stock from that point, correct?
Yeah, we've had a couple of analysts actually initiate coverage on us in the last few months, and that certainly raised the profile of the company beyond what it was before.
Do you think that that's attributed to the rise in valuation here, or do you think it's more an Elon Musk, bid? What's your take on that?
Yeah, it's a good question. I think it's a little bit of both. Getting analyst coverage has certainly helped broaden our audience and raise awareness. I think there's been some building anticipation about what this economic study might show, which we think the results kind of should exceed those expectations, frankly. And certainly the comments made by Elon Musk are significant. It really shines a light on the need for more nickel production, and in particular, the need for nickel production to be done in an environmentally and socially responsible way, which frankly, a lot of nickel production today does not meet that criteria. And so if we're all going to move towards a low carbon green future, having nickel mined from a responsible source is actually a big challenge for the nickel industry. And so companies like ours, which could potentially be part of solving that issue, I think some investors have seen that opportunity to sort of position in to names like ours that are part of that broader sort of macro theme.
Right, and to credit John Kaiser, I think he was the one that wrote you guys up probably around 20 cents Canadian and said it was a 8 or 10 bagger, and we're not there yet. But clearly he was more right than a lot of the analysts out there or anyone in the peer group, right? I mean, it's been a really nice move in the stock, and we've been very fortunate to have met you last year early on, and we consider you a top 10 holding. So, anything else that you'd like to add before we leave?
No, just we're really excited to have the PEA out. Just brings a lot of the work that we've done over the last several years together and shows what the impacts of each of those achievements has been when you look at them collectively and what the impact they have on the economics. And we're very keen to continue to move this project forward aggressively.
Well, we really appreciate you coming back on and giving us some time here in a busy week for you, Martin. And the website again, folks, is www.fpxnickel.com. Martin is very open to clients and high net worth individuals contacting him directly. I know I've referred a few people to you, Martin, that spoke very highly of what you did with them, and we really appreciate the time today. For more information, folks, on what we do, check out feneckconsulting.com or miningtechnica.com. Thanks again for your time today.
Thanks, John. Appreciate it.